throughout 2021 and going into 2022 against the US dollar. You can see the same situation against the New Zealand dollar. We've had a lot of weakness in the yen. We've had a lot of weakness in the yen against the Aussie dollar, for an example. Same situation has played out. Same situation has played out for the yen against the Canadian dollar, for an example. And the reason for the yen's sustainable weakness is the interest rate differentials between Japan and these other countries. So, if we have a look, for an example, at what's going on, we know for to start off with that energy prices are extremely high all around the world. Oil is now $107 a barrel. The war in Ukraine caused oil to go even more higher because Russia exports a lot of energy to Europe, and that energy is getting disrupted. And the potential for blocking Russian energy exports is also causing energy prices to go higher. So that effect in countries like the United States is very, very apparent at this moment in time. So in the US, inflation is at nearly 8% right now. That's far above the central bank's 2% target, and inflation expectations are already at 3%, again, which is above the central bank's 2% target. So the central bank has to bring down inflation to make sure that the purchasing power of paper money is not losing its purchasing power to inflation too aggressively, because wages are only growing at 5%. So that would mean consumers are losing 3% of their dollars to inflation. That's a big problem. That's why the Federal Reserve just raised interest rates this week. And we've got another one, two, three, four, five, six rate hikes in the United States coming in 2022. The same situation is happening in Canada at the moment. Inflation's high, inflation expectations are high, and that's why the central bank in Canada is also raising rates throughout 2022. And the market is expecting a lot of rate hikes in Canada, even more than the United States as it stands. Australia's inflation is also high. Um, at the moment, it's going to come out much higher than 3.5%, which was the last reading in December, because inflation comes out quarterly, and that's why markets are betting on rate hikes in Australia. And the same thing in New Zealand is already happening, with a lot of rate hikes already taking place and further rate hikes throughout the year to deal with New Zealand's high inflation. And the latest reading was at 4.9%, and we haven't even got the latest quarter. So a lot of interest rate hikes are happening, and look at the interest rate differentials between these countries and Japan, because Japan is not having an inflation problem. You can see here, inflation is only 0.9%, not above the central bank's 2% target. Inflation expectations are below the central bank's target. So the central bank in Japan doesn't have to raise interest rates anytime soon because they're not dealing with high inflation. So if you now look at the interest rate differentials between Japan and these countries, now you can see why the currency markets are moving the way they're moving. 0.15% interest is what you'll get paid if you borrow money to the Japanese government. Compare that to how much interest you get paid if you borrow money to Australia. You get 2.25% interest. If you borrow money to the New Zealand government, you get 2.82% interest. You borrow money to the United States government, you're getting 2% interest. So there's a very, very widening gap between the interest rates in Japan and these countries. Canada is also at 2.19%. And when I show you this chart, you can see how interest rate differentials really do drive the currency markets. Here you have the 10-year government bond in New Zealand, then you have the 10-year bond in Japan, and the difference is minusing the yen yield, the Japanese yield from New Zealand, and then you can put the New Zealand dollar Japanese yen on top of that, and you can see the exchange rate highlighted in orange follows the differential highlighted in blue. They literally follow each other. When the differential is narrowing and it's not as favorable in New Zealand, then you see the Japanese yen getting stronger against the New Zealand dollar. But as soon as the differential starts to widen in favor of New Zealand's government having a higher interest rate, the currency pair follows. That explains why the New Zealand dollar is going higher against the yen. It explains why the Canadian dollar is also going higher against the yen. You can see the same pattern play out in this currency pair. When the interest rate differential is going in favor of Canada, you see the exchange rate moving higher. They literally move with each other. They are a mirror image of each other. And at the moment, the differential is firmly in favor of Canadian dollar, and that's why the currency pair is pushing to the upside. Same with the Aussie dollar, same with the British pound, for an example, same with the US dollar. It's all about interest rate differentials. And with all these interest rate hikes coming in 2022 in these countries, it's just going to mean that Japanese investors have no choice but to sell their Japanese yen, buy US dollars, buy Aussie dollars, buy Canadian dollars, buy New Zealand dollars, buy British pounds, because these countries are paying a higher interest rate. And if you're a pension fund, if you're an insurance company, if you're an investor that doesn't like to take risks in your portfolio by buying stocks, commodities, crypto, Forex, for an example, and you want to buy a secure investment which guarantees you get your money back, then you're going to buy a government bond. So that explains, guys, fundamentally why the yen's weak, and that's why we have to keep having our bias towards buying US dollar JPY, buying the Canadian dollar against a JPY, buying the Aussie dollar against a JPY, buying the New Zealand dollar against a JPY, because these currency pairs are going to continue to move in favor of these currencies. And yesterday, when the Bank of Japan had their meeting, the central bank has basically said they're not going to raise interest rates anytime soon. And this is causing the divergence in monetary policy. And when I say divergence, it means that the higher rates in these countries is diverging away from Japan's low rates. And again, that divergence causes currency pairs to move in the direction that they're moving in. So that explains, guys, fundamentally what is happening right now in the markets. So that explains how we have to trade the yen against these currency pairs moving forward. So, guys, I hope that makes sense. Thank you for watching.